Investors got a rude awakening this morning when they saw the global risk-off sentiment on many financial markets, and especially equity markets came off very strongly overnight following yesterday's development where the Silicon Valley startup bank SVB basically had to sell $1.75 billion of its shares in order to prop up its balance sheet after having had to sell a 1.8 billion bond portfolio, which basically lost them a lot of money. And that then led to investors being worried about their money with SVB Bank. And despite reassurances from the bank's board, the share price of SVB dropped by 60% in just one day. And this came also on the back of the liquidation of the crypto bank Silvergate, following mass withdrawals of deposits after the collapse of the FTX exchange. And altogether basically led to a $80 billion wipe off the value of banking stocks in the US yesterday, and tech stocks also took a large hit. And these worries about the solvency of banks then also were seen in Asia, where Asian markets dropped, and with regards to European markets, a lot of them dropped as well overnight very sharply on these worries. And the UK banking sector, for example, gapped low by 4.5% overnight. So let's just have a look at the impact of that on the FTSE 100. And as we can see here on the daily financial bet, we not only fell through this key support area I've been mentioning over the last few weeks between the 10th of February and the beginning of March lows between 7,854 to 50, but we also in one fell swoop basically dropped all the way back down again towards the January lows, which come in all the way down to 7,708. Now, today we are holding there short term ahead of today's US non-farm payrolls data, as investors want to see what is likely to happen with regards to the payrolls in the US. And that is out at 1:30 p.m. GMT time later today. And we expect payrolls to fall by 200,000 after we've seen that very high reading, nearly triple the estimate back in January of 517,000. We'll have to see whether that will also be potentially reverse that high number when we see a revision of that data. And we'll also have to keep a close eye on the unemployment rate and see whether that holds in the US at the current 3.4%, as well as have a look at average hourly earnings, which are expected to rise by 0.3% on a month-on-month basis and by 4.3% on a year-by-year basis. So a lot of data out later on out of the US, which will also influence, obviously, the decision that the US Federal Reserve has to make at its monetary committee meeting on the 21st and 22nd of March with regards to the future policy of the Fed rate hikes. Now, at the moment, the market seems to be pricing in a 50 basis point rate hike for the March meeting, but we'll have to see that that will be more likely after today's unemployment data in the US. And that will also then have an impact, obviously, on the FTSE 100. And as long as we can bounce off this support area we're testing at the moment, we could still stabilize, because after all, the uptrend is still intact. Having said that, given the sharp sell-off we've seen over the last 2 days, the odds are at the moment stacked for further downside to be seen. And if we were to see a daily close today below 7,708, the low from late January, on a daily closing basis, and it being Friday, also meaning on a weekly closing basis, then that to me would say that a top has been formed with regards to the FTSE 100, and that we could very easily over the next few weeks and months slip back down again towards the 200-day simple moving average here and rate at 7,422, and also towards the late December low at 7,296. So the current technical support that we're seeing here all the way down to 7,708 is really, really important from a technical perspective. Now, if we were to hold around this area, what we need to see for the bulls to be back in control, though, is a rise above that previous support zone, now resistance area between 7,850 and 7,854. Only if we were to close above there on the daily closing basis could we believe that this could perhaps be just an ABC zigzag correction in terms of elliott waves, and that we could then see another move to new highs being seen. But as I say, the bulls need to take the FTSE 100 back above 7,854 on a daily closing basis for them to be back in charge. But right now, the bears are clearly the ones who control the markets. Now, with regards to the German markets, DAX 40, which has really been outperforming not just US markets, but also European markets to a large extent since the beginning of the year, what we can see here is that we have seen a very muted sell-off on the DAX 40, and it has taken us back down towards the October to March uptrend line. But as you can see here, we're currently in the process of bouncing off that uptrend line. And we haven't really come off that much if you look at the chart compared to the FTSE 100, for example, because we're still trading above minor support here, which I mentioned last week, between 15,184 and 15,145 between the late February and early March lows, below which there is this major support here, which is made up of the mid to late January lows between 14,992 and 904. So as long as we stay above there from a medium-term perspective, with regards to the chart, for me, we basically remain in an uptrend because we can still see a series of higher highs and higher lows. So today's bounce off this uptrend line also gives us further hope that if we can maintain it today on a daily closing basis and thereby also on the weekly closing basis, then perhaps the DAX 40 can actually maintain its uptrend in the days ahead. But we'll have to watch and see what happens next week, because we've got also US CPI data out, which will be watched very, very closely. So far, CPI with regards to Europe has come in, for example, today, as expected in Germany. So we haven't seen any unexpected rises there. But if we were to see that in the US, then we would probably see the Fed being much more hawkish going forward. So important data coming out next week. But so far, right now, we are holding with regards to the uptrend and with regards to the DAX 40. And if we were to fall through this uptrend line today, then we probably have pretty good support between 15,185 and 15,145 with regards to the DAX 40. Now, moving on to US markets, we can have a look. This is the dollar yen that I'm going to show you in a minute. But looking to the S&P 500, we can see here that we've had a very sharp drop yesterday on this news that SVB Bank had basically had to sell $1.7 billion of its shares in order to prop up its balance sheet, to plug a hole which was about 1.8 billion caused by the sale of a 21 billion loss-making bond portfolio, which mainly consisted of US treasuries, which were yielding an average for that portfolio of around 1.79%, and that is far below, for example, the 10-year treasury yield of around 3.85% today. So this 21 billion loss basically in the portfolio led to a huge loss that needed to be plugged with regards to SVB's balance sheet, and that share sale yesterday basically led to the huge 60% drop in its shares value, and then dragged down other bank shares as well. And as you can see here, the S&P 500 not only fell through its uptrend line going back to October of last year, but also through the 200-day simply moving average, which over the last 2 weeks has actually held the downside and provoked a nice reversal last week. Now, what has happened is we are clearly trading below these levels, and unless we were to manage to perhaps bounce back on positive non-farm payrolls data later today and close back above the 200-day moving average of 3,935, and also above the breached uptrend line going back to October around 3,950, unless we close above 3,950, I would rate the odds of further declines being seen much higher than the market heading back up again. So we'll have to see what happens later today, because the weekly close on a Friday is also very important technically. Now, if we were to fall through today's low at 3,883, which is also marginally below the 19th of January low, then the next downside target would be the December low, 3,764 for the S&P 500. Failure there would really mean that the downtrend from last year, the bear market, has actually resumed, and that we could see the S&P fall through the October low, 3,491 on this daily financial bed going forward. But we're not there yet. Let's see where we are today with regards to the non-farm payroll data, and also next Tuesday with regards to US CPI, which is really critical. If both of these come in better than expected, we could once again see some upside in regards to US equity markets. But for the time being, as you can see here, we are now trading in a very clearly defined downtrend channel on the daily financial bed here since the beginning of February. FX markets have also been impacted by this risk-off sentiment coming out of US markets, and especially the US banking sector. And the US dollar, which had been quite strong over the last few days, actually consolidated, and also did so ahead of today's non-farm payrolls data, with non-farm payrolls at 1:30 p.m. GMT today expected to come in around 200,000, much weaker than the 517,000 we saw back in January of this year. And this number can actually be revised, so we'll have to have a close look at that, and also look at the unemployment rate and see whether that can hold at 3.4%. And the average hourly earnings are also very important. Will they come in at the expected 0.3% month on month and 4.3% year on year, or not? So all of this will have an impact on the US dollar, and we can see here the US dollar versus the Japanese yen. And we can see that it did slide slightly overnight. We had, of course, earlier today, the Bank of Japan, which left its interest rates unchanged at minus 0.10%, and also the 10-year bond yields around 0%. And they made no tweaks to the yield curve control. So we still have the 0.5% cap on there with regards to bond buying in Japan. Now, this was Governor Kuroda's last monthly meeting. He will, of course, be replaced by Kazuo Ueda, who's expected to move the bank away from its ultra dovish monetary policy, but do so very gradually. So what we can see here is the impact of all of this on the dollar-yen exchange rate. Is that we have slightly risen with regards to the US dollar versus the Japanese yen, and remain above this key support area between 134 yen and 77 sen and 133 yen and 63 sen, the low from early December and the high from early January. And basically, we are currently trading below the 200-day simple moving average at 137.47. If we were to rise above that, we would then be heading back up again towards the mid-December high at 138.17. But right now, as you can see, the chart is quite constructive and is pointing higher. With regards to Europe, you can see that here also the US dollar has actually leveled out at 105.25, marginally below the late February low, and did so also on a more hawkish European Central Bank, with Christine Lagarde saying that further 50 basis point rate hikes are expected to be seen in regards to European rates. And we can see here that euro dollar is rising very, very slightly, but basically below, as long as it remains below the February to March downtrend line here at 106.45, further downside is likely to be seen in the next few days and weeks. And if so, we could then slide back again towards the 104.84 to 104.44 support area, made up of the mid-November low, and the early January lows. For the bulls to be back in control, though, for the euro-dollar exchange rate, what we need to see is a rise above the 7th of March high at 106.95. Only then could we see some upside being seen again. Moving on to euro sterling, we can see here that we broke through a 1-month downtrend line which because of inverse polarity can now act as a support line, and that's why I've drawn it in with these dashes. But as you can see here, we're actually sliding again, so I can actually remove it here. We've faltered at 89.25, just below the mid-February high at 89.28, and you can see that once again we are heading back down again within our sideways trading range that we've seen since the beginning of the year, and are heading back down again towards a minor support line here, and also the early March lows at 87.55, but likely further downside short term to be seen with regards to euro sterling. Commodity markets have benefited from the risk-off sentiment we've seen in equity markets overnight, and we will have a look at gold and silver in a moment. But first of all, I'd like to quickly have a look at WTI as well, because we've been following this quite closely. And you can see here on the daily financial bet of WTI that we are still trading in this sideways trading pattern since mid-November that we've seen, and that we failed earlier this week at $80.98, just marginally above the mid-February high, and are heading back down again towards the $73.85 low seen at the February low, the 22nd of February low, and below there we've also got the support line going back to December of last year, which currently comes in around the $73.85 mark. So that is the downside target short term with regards to the price of WTI, unless we were to see a bullish reversal, which is not expected to be seen, take us above Thursday's high at $78.12. Now, as I was mentioning, we also have the gold price, and we can see here that gold has benefited from the risk-off sentiment from the US markets yesterday, in that it has now rallied and is approaching its February to March downtrend line around the $1,840 per troy ounce mark. If we were to break above there, we also got resistance going back up towards $1,847 per troy ounce. That's the 20th of February high. And above there, of course, we've got the current March high at 1,858. This would need to be taken out for the price of gold to really reverse and to then be heading back up again towards the $1,900 mark. But right now, we're just trading sideways with a slightly bullish upside bias, and basically remain bullish as long as we stay above the February low at $1,805. And when we move on to silver, we can see here that the price of silver continues to trade in a downward trending channel and has been doing so since the beginning of February. And it now has, if I zoom out a little bit, basically dropped to levels last seen in November of 2022. It fell through the mid-September high of 2022 at $20.01, dipped to $19.90, and now is trying to stabilize around the psychological $20 mark, having slipped through the 61.8 Fibonacci retracement, which can be seen at $20.27, and which may act as resistance today. If it were to be taken out, then perhaps we could see a move back towards the late November low at $20.58 being seen. But for the bulls to be really in control, what we need to see is a rise above the red line here, the 200-day simple moving average, $20.94, and also a rise above the last reaction high, that is Monday's high at $21.30. Only then could the price of silver rise again. Right now, it is just consolidating and holding at this uptrend line going back to September of 2022. So it's interesting how previous support lines actually work going forward in the future. Now, I'd like to thank you for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.